The most common source of commercial crime insurance claims is loss from crimes committed by employees. The volume of these crimes is high, and the size of the typical loss is large. In a 2019 study by the ACFE, the median loss worldwide was $125,000 per case. However, 20% of the employee crime cases had a loss of more than $1 million. A particular challenge with employee crime is its complex nature. It's about people and the relationship between employee and employer. Employee crimes can't all be prevented simply by adding an extra lock to the door. Employees are a trusted part of the organization. They have access to inventory, payroll, financial statements, vendor account details, and more. And they need the access in order to do their jobs. So, has the trust been misplaced? Management places the greatest level of trust with senior staff and those who've been with the organization for a long time, but the crime facts show a stark reality. According to the ACFE study, the higher employee rank, the greater the median loss. Also, the longer the employee tenure, the greater the median loss. So why do employees commit crimes against their employers? The motivation for employee crime is as varied as the employees themselves. Sometimes it's as simple as because they can. Of the 2,504 cases reviewed in the ACFE study, 42% of the fraudsters were living beyond their means, while 26% were having financial difficulties. Were greed and need the main motivation for committing crimes against their employers? Did they have addictions to feed? Were they disgruntled and seeking revenge? Or did they just see an opportunity that was simply too hard to resist? Employee crime occurs when opportunities are presented, especially when there are no checks and balances in place for prevention. Crime happens when risk management procedures are overlooked. It also happens when too much trust is placed on individuals. Small organizations with long-term trusted employees can be very susceptible to crime. This is because trust and long-term employment are often used as a substitution for segregation of duties and strong internal controls. Small business owners and managers also tend to trust their employees on a more personal level since they have more contact with them. Small organizations have less personnel and may also lack the resources needed to enact adequate risk management procedures such as auditing policies and vigorous hiring practices. If you enjoyed the video, like it, share it, and tell people about it.